All right. Good morning, everybody. Got a weird start to the week. You're going to see market maker move on the futures all week, which is a little tricky. It's because of the roll, right? So there's a lot of volume taking place. This is OPEX week, and that volume or that trading activity is going to be picked up by the indicator, and it will hide through hedging. So you're going to have to ignore the market maker move signal through the week and just kind of hope that it isn't a day where they actually are hedging. What we'll do on those days is look a little closer at the volume, right? Because if they are hedging, they shouldn't be trading. We say that, but there was a few even just last week where we saw hedging and market maker move. This is the thing about indicators, that everybody has to struggle with, and that's the fact that indicators are stupid, right? They can only do what they're designed to do, and that's it. That's their limitations. They can't think outside the box. The problem is we need to think outside the box because we're getting the signal there for the market maker move, but it's not hedging. It's just them rolling the contracts. So it's not the end of the world, and things will go back to normal quick enough, right? Next week we'll be back to normal, and then we'll be able to use the market maker move signal without worrying about whether it's accurate or not. So OPEX week, the flows are going to be a little weird, not just the market maker move, but across the board. You'll see volumes that don't imply participation. The volumes will just imply continuation, right? So when they roll a position, we don't know where their destination is. They could be rolling up, rolling down. They could be closing it out. We just don't know. The transaction comes through the tape that there was a trade that took place, but we don't know if it was buy to open, buy to close. Obviously, if it's in the front end, it's going to close either way. But we just don't know where they're going to. And we'll have to look at the options data afterwards to see where they did roll to, right? Like we can see change in open interest, and that kind of points us in the right direction to see where they're going. We're kind of flat right now through most of the world, but Japan is down more than 1.5%. We're going to get a lot of Fed speakers out there chipping teeth. The thing is, they're all trying to sound like they are their own person, that they have their own original thoughts, but they got to toe the party line and sing from the same hymn book. So it's our job to try to figure out what the underlying message is. And usually, it starts to creep out. There are a lot of Fed speakers, and you could find it's a little difficult to keep track of them all. I continue to try to push people to use AI more. Use AI, ask them, okay, who was the Fed speakers today and what was their collective message? And just let AI do it for you. The more you use it, the more you'll be comfortable and familiar with it, and the better you'll be at it. So you just got to keep doing it. Empire State Manufacturing and a couple of Fed speakers. Those are the biggest things on the table today. Going to get a lot of data out of Europe this morning, some retail sales uh, tomorrow. By Friday, we'll start to get into some of the big stuff. Why is this not Friday? All right. Well, we are not seeing Friday, I guess. This would be a little weird. It is a short week, so kind of keep that in mind. Messes with the premiums a little bit. These kind of weeks are always a little tricky, just from the point of view of not being able to lump the flows into a particular category the way we typically would. I got some good news about the ADR indicator that we use on Thinkorswim. The one that I built doesn't do this. It doesn't let you look back over previous days. And when I built it a couple of years ago, I didn't know how to do this. And I didn't really work that hard to try to find the answer either. I just left it alone. And so all we've ever had is the one that was right up front. Someone over the weekend found somebody else's version. And after I get it cleaned up a little bit, we'll put my labels up here that tell us the average daily. This is the new one. It's not done yet, as you can see, but it does have all the previous days. This is the one that we would typically use with these labels up at the top. So give me a day or two. Let me get my labels built into it and change the lines so that the colors are the right way. And then I will share this one out. If you're on Thinkorswim, it'll end up in the Thinkorswim workbook. And of course, I'll give credit to the creator because technically this isn't my indicator. This is just a free one found on the internet. But we need to modify it a little bit, right? These lines, so the first thing I changed, they were continuous. So it was really noisy, really messy. Kind of clean it up a little bit and give you the ability to turn these extra lines off if you don't want them. But you do want them. That's the whole idea. Mine just stays in the front. And so you have to try to keep track of what's going on a day-to-day basis to really understand how powerful this thing is. It's absolutely amazing. It's a game changer if you're day trading, not just in the futures, but mostly I use it in the futures. This is what the market does on average over the last month. So that's what it's set to a month. What has the market done at its highest point or its lowest point on a day-to-day basis? And think about that. The market can be kind of bullish today. It can just open and run its average distance in one direction, or it can open and kind of just chop about, giving its average between a midpoint of high and low. So the two red lines or the two what should be yellow lines. When you can look back and get a feel for how this thing behaves, then you've got a cleaner idea of what to look for on a day-to-day basis, how it behaves. It gives you something to use for research rather than only having the one up front. The one on TradingView already does this. There's no adjustment needed over there, just this one. So thank you for the person, you know who you are, for bringing this to me so I can adjust it. It's awesome. Spot gamma levels. We're above the volatility trigger, zero gamma, and the put wall. We want to see this put wall get rolled up this week and get a lot closer to price. That would be considered bullish. We don't really need the call wall to move yet. We would expect the call wall to stay where it is until later in the week so we can run up and challenge it and maybe have that hold as our cap or our resistance on the week. The main focus for me is that put wall, seeing it rolled out or not. The volatility trigger and the zero gamma, yeah, they might move around a little bit, but my main focus is on seeing that put wall move. Spot gamma had the PM from last week and the AM from this week already out this morning, so I shared that. They're talking a lot about the amount of money that's coming off the table at the end of this week and how it's going to free things up. We could see an entirely different market as we come in next week. The gamma index is still at 2.0. This is an indicator that ranges from a -4 to a +4. When it's in positive territory, we expect the market to kind of not expand, not trend, not continue to go higher or lower a considerable distance. We expect more chop. range. If it was close to -4, then we would expect continuation, breakouts, expansion. So we're in consolidation area when it comes to the gamma index on the S&P. Your numbers may look different than mine. Right now I've got the ES at 5501. If you haven't adjusted for continuous contracts, then you're going to see a large gap here between the old contract and the new contract. You can adjust that change just by adjusting for contract changes. You don't have to, and in fact, the old one is still open if you want to be over there. Just be mindful of the volume. As the week goes by, there's going to be less and less volume on the new contract. So we can see that the June contract has 4 days left, and there is volume there. It's 150,000, and there's 180 on the new one. But as the week goes on, that volume on the front one is really going to diminish. And so that's going to make it more and more volatile and just more dangerous. So if you haven't rolled, probably want to consider rolling it. And then once you do, if you end up with that big gap, just adjust for contract changes. Every broker is different. So I don't know how to adjust your broker. If it's not think or swim, right? If it is think or swim, just go to the gear icon, go to futures and click this button, adjust for contract changes. Save your chart that way so that from now on, it automatically does that and you don't have to worry about it. You can see this discrepancy, how there's this very large gap here from where we closed and where we are now. This discrepancy will go away after a few days, even if you've adjusted for contract changes. You're very likely to still see that gap, right? I had that adjusted before I hit the button on the weekly. It still looked like it was still way up there. See, I'm adjusted for contract changes on the weekly and it's still out of whack. That's just a broker thing. They'll have it visually fixed in a day or two. So no stress there. Either way, with or without the adjustment, we're still above the 10 or above all the major moving averages on the weekly. So we really have nothing to worry about on that front. The pivot channels are touching. They're not necessarily overlapping, but they are touching. So we consider it overlapping. The channel today is really wide, which implies sideways. A lot of things that we're going to see this week implies sideways. It's a short week. We've got, a lot of Fed speakers. It's OPEX. We don't expect this market to really break out and go anywhere. That's a big deal, and it really matters on how we approach the week, what our expectations are for the week. So we want to hold the range or expect to hold the range. It is possible that we break out. I don't want to make it sound like we can't, because it is possible. But this is the range that we're in now that we have to deal with. So 54.50 and 55.11 cog line. The 60-point range is pretty tight. Even for a 4-day week is pretty tight. Think about how things went last week when we were stuck in this range. or back here. So tight range, we consolidate, build up a lot of energy. Then we expend that energy. And then same thing again, build up a lot of energy and expand that energy. Volume looks okay, but as I mentioned, we're not going to be able to really lean on that this week. Ten-day, 30-minute volume profile. We're still not expecting this point of control to move yet. We're only going to expect this to move if we actually get more volume up at this level, which, since this is the range that we're likely to maintain for the week, shouldn't be that hard to do. Normally we'd be focused on the left side, and as these volume candles disappear, we'd be getting, the decrease on this high volume node. Then we wouldn't see any of this disappear until much later in the week. We're talking, Wednesday afternoon into Thursday, Friday, and then next week. And of course, there's no Wednesday this week, right? Juneteenth holiday is going to jump us a day. So by the time we get into this volume, we should already have had the change in the point of control. So when we come in next week, we kind of play out the scenario of how this is going to look. We'll have this really tight range, and we will be at the point of control, maybe above it or below it, but we'll be at that level. And that sets us up for a really big move if we can keep it. So we're talking about holding this range into Monday of next week and then exploding out of it before the August QRA and FOMC and all of that stuff, right? Another really nice expansion before we get into the next level of economic junk that's holding us back. On the other hand, if we come out of this to the downside next week, then we're likely going to remain, under pressure until QRA and FOMC August. And I find it unlikely that we'll be able to come back out of it and rally to the upside until after QRA. So this is kind of the line in the sand. We have to keep that 5,500. This week, we're going to likely digest it and chop about, right? But we're talking about next week when we come out of this and which direction we go. We do have a new VPOC from Friday. Now, not sure how much value that has when we think about we're in a new contract series. And this is a mix of contracts. Last week, we still had traders trading this new contract. So it could be a little bit of both. I'm willing to leave it on for now, but any of the old VPOC levels from the June contract after next week, probably just want to take them off the table. If we zoom out and kind of look at some of these levels, none of these are going to do us any good if we were to go back and revisit them, because if they're representing a place of unfinished business, well, the business is finished, right? There's no concern of trapped traders when that contract doesn't even exist anymore. must have hit a button somewhere. So 54.88, just below a cog line, 54.92. And it looks visually like it's lining up with the halfback. Kind of missed that a little bit. Not quite at the half. Now we're really flat on the day. We haven't done anything. There's no edge towards one side or the other. Usually we come in the morning, we're closer to the lower or we're closer to the higher. And that gives us a little bit of edge to say, well, we're probably going to go ahead and tag that line since we're close enough to it. It'll start to act like a little bit of gravity. But we're right in the middle. We haven't done anywhere. We haven't gone anywhere. And then we've got this week. So we measured the range on Friday and compared it with the range that we had last week, trying to get a feel for the new week. These ranges are derived by volatility. If the volatility is greater this week, the range will be bigger. And if the volatility is less this week, then the range will be smaller. We can see from the box that I just laid here, after I measured last week's, set it on this week's range is bigger. But this is misleading. It's not just a little bit bigger. It's a lot bigger. This range is derived by volatility, but there is a context of time in there. Last week, we had a 5-day work week. So it was volatility for 5 days. This is volatility for 4 days, and it's bigger than last week. If it was a 5-day week, we could say, the volatility is a little bit bigger because there's a bit of a gap here, but it's a 4-day week. So it's much bigger. One way to kind of visualize how much bigger it is take the distance between these two. Subtract the top number from the bottom number, and that gives you number A. Do the same thing for this, and that gives you number B. Take A, divide it by 5. Take B, divide it by 4. Look at the difference between 5 from 4. Or from the entire equation from A minus B at that point. That'll tell you an average of each day for last week and an average for each day this week and how much bigger this is. There's a lot of volatility pumped into this week is the point. I would say it's a gray area and that it would make an excellent thing for you to nerd out on and figure out. For me, since I've already got enough pivots, I will throw them in the trash and I won't focus on them. But that doesn't mean that they don't have some weight to them or that you couldn't find some validity, especially if you can go back to other previous contract changes. It's not like this is the first time we've ever had a contract change. You could go back into previous years, look at the contract changes mark them going forward with the volume profiles from that time period and see if they were respected when price came back to that area. But I've already got so many pivots, and my intraday measurements are much more powerful than those generic volume pivots that we get on a day-to-day basis, that I mark them because I know they have value. And usually price responds there and gives me some insight on the day. But my own intraday pivots are much more valid and respected and trusted. But if you don't have enough, I mean, there's always room for more. Kind of like the doors, the day one open range on equities is pretty awesome, but on futures, it's kind of worthless. And it was disappointing, but at least I found an answer. I don't like staying in that gray area of the unknown. Get an answer, and then distance from the 10-week, we are in the sweet spot, the spot we are looking to be at between 2 and 4. It's kind of where we want to be. It shows that the market still got participation and drive in that continuation of whatever, because we could be to the downside too. So it could be a continuation lower, it could be a continuation higher. And it's what we've had since the November QRA, when everything changed all the way back here, right? So we came out of the QRA in November. We held that 2 to 4 range all through the early part of the year and really gave it up in late March, early April. We're now getting back into that sweet spot. Kind of want to hold it here, but it's a nice visual, and it kind of goes to the question of how's it looking for the longer term portfolios. Gerald Appel wrote a book. It's kind of an old book, but it's a really good one, where he talks about just keeping it simple. And as long as the Fed isn't raising rates and the market is continuing to ride above some key moving averages, and you can just throw out a random number, 50, 200, if it's holding above those and the Fed isn't raising rates, then kind of expect the market to continue to march to the upside. Not necessarily the indexes themselves, and even sectors, they'll start to flatten out a little bit. But equities, you just want to continue to watch for layoffs, companies missing their earnings targets, that sort of canary in the coal mine signals. But we are looking really good on distance from the 10-week. We're not overbought or overextended or any sort of language like that. We are exactly where we would want to be. Kind of like setting the cruise control right at the speed limit. You're not going too fast and you're not dragging your feet. Just perfect. Distance from the 10, we're kind of fading back here a little bit, but that can be misleading. We don't need price to go anywhere. If it stalls out, say at 5,500, all we have to do is stay stalled out right at 5,500. And our distance from 10 is going to get closer and closer and closer, because the 10 is moving every day. It's going to move closer to us. So we could backslide. We could fade back and tag that 10. But if we're holding on the idea that we're not really supposed to go anywhere this week, then this will be another argument for a continuation next week, that we go sideways through the week. We give this 10 time to catch up with us. We give the 10-day volume profile time to move that point of control up. We come out of all of this sideways IX10 compression next week with a really nice expansion. And so far, that would be an expansion higher, not lower. Still want more data first, but everything's pointing higher at this point, and it's still really early in the week. Semis are up this morning. I've seen Broadcom was leading the pack and MU was right behind it. So, if semis are up, hopefully they're not going to do all the lifting on their own, but we could get a nice expansion through other equities. This is the 9 grid that I tend to watch when it comes to the sectors out there. Now, I use spiders, but I know other people that use Invesco, or, I mean, you kind of take your pick. There's a lot of different companies out there where you can do a sector evaluation. I've always just kind of liked the spiders. That it works for me. And by the way, they have a fantastic website. If you haven't gone there, it really will help you understand the weighting of what's in these things and give you access to all kinds of tools for free to evaluate these ETFs in various ways. So just go to Google, type in, spider sector ETFs, and you'll find their website. They got a nice mobile app too, all free, including like a weekend update where they'll email you and give you like a rundown of changes of money inflows and outflows. Lots of great perspective, all free. The reason I bring this one up is I have my tag here in the upper left corner of each of these charts showing a 5-day change. Basically what happened last week. That's a good point. I'm not sure. I know that there's an S&P change coming because some names were on the list for being added to the S&P. So it would make sense that we're also going to see a rebalancing in the ETFs as well. But I will make a note of that, and I will check. The question was, for anybody watching the replay, isn't there an XLK rebalance this week? And my answer is, I don't know, but I'm going to find out because it's a really good question. I know I'm not supposed to say I don't know, but I'd rather just say I don't know. Over the last 5 days, we can see that tech really expanded, and the concern is that it's going to take a breather, right? If it calls time out and takes a breather, the entire market could take a timeout. That's the fear. Now, there's other ways to look at tech. Semis alone have their own ETF, for an example. So we could go that route. Communications, consumer discretionary. There's other names in that weighting in the NY Fang index besides, quote, tech. But those names still kind of filter into tech anyways. If you think of Apple, just for an example, and how many companies are on Apple's supply chain, that's a lot of companies. I used to have a spreadsheet for it, and it's a pretty good list of names. And those names are tradable on the exchanges too. So if Apple stalls or has a bad week or has a good week, so do those names, right? In general. Could the same be said, across the board on a lot of the other Mag 7 names? Then we also want to think about the ones that have stalled over the last 5 days or maybe haven't done anything. Just a little mean reversion sort of outlook, right? How many of these are near their 50? How many are above their 50? The QQQ was really close to its put support. That was one of the pictures shared. The Menthor Q picture. There was two. Thought I shared them. Huh. Oh, it's the call side. My bad. On the put side, we had GE and Loves. It's the call side that we have QQQ. Now I got to find it. There we go. 480 call resistance. Put support 427 or 424. And the 0-day call resistance 483. So on the week 480, on the day 483. The 0-day put support 470. That's going to act as a resistance level if the Qs rally up into 483 today. And for GE and Loves, it'll act as a support level. And if we are below it when we open, then we can see a very fast continuation beyond it, like GE's already underneath that level. Oh, okay. Come on, Thinkorswim, catch up. Yay. So things that are down, nat gas, it's down 2%. And the TNX, which is still not functioning for me on Thinkorswim, so I don't trust anything that it says when it comes to the TNX. Gold and gold miners, bonds. And since both of those are down, I'm going to assume that this TNX is just wrong because it's Thinkorswim and it's been having issues with TNX. TNX is probably not down, but TLT probably is. TLT is up 4% over the last 5 days. So this could just be a little bit of a pause or a digestion after such a move. Flip it in the other direction. The VIX is up. The FANGs, semiconductors, China ADRs. So it's a good start. And volatility on the Qs are up a little bit too. It's the semiconductors that I keep coming back to this morning. I don't point this out enough, but I was talking to somebody about it last week and realized I haven't mentioned it in a while. On Thinkorswim, there's something called Trade Flash. They post stuff in there, and it's got algos that post things in it, but it also has humans that post things in it. So it's not just some algo. The things that post in there can be anything, things that they think might move the market, things that they think are unusual options activity, unusual futures activity, really just all kinds of stuff. It's searchable if you know, are interested in a specific name, say Apple or Spy, whatever. So it has that, and it's run by a company called Hammerstone Markets, which is one of the most expensive month-to-month services I've ever come across. I don't have the service, but every year they'll offer you a free like 7-day trial or something like that. And it's a program you download into your computer, and then you get emails and summaries and a comprehensive package. Very expensive, but very in-depth, robust, impressive actually. To me, I think it's overkill. It's like trying to kill a fly with a bazooka. But if you're looking around for, a comprehensive news service and you're willing to pay up for it, Hammerstone markets might be something that you want to look at. If you're looking for something free, just to kind of get a feel for what's happening on the day, especially those days where something happens and I'm like, why are we running or why are we falling? And I'm looking around and I can't find anything in the news. One of my go-tos is to check Trade Flash and see if they know why we happen to be rising or falling and nobody else does. Not to say that they have the answer, but it is one of my go-tos. And on Thinkorswim, it's free. You're not getting the full Hammersmith or Hammerstone markets, but you're getting a good taste of it for free. It doesn't cost you anything. So if you're not using that widget, why not? It's free. It doesn't cost you anything. It sure would be due a breather, that's for sure. You know, at some point, it's got to digest. Nice. Another new feature on TrendSpider. These guys don't stop, and they're always coming out with something different. Relative performance, like that. I'm gonna have to dig deeper into it later. So as we've mentioned before, when it comes to cloud computing and IGV, don't trust those ETFs. Always go in and look to see if we're getting any sort of flows. Otherwise, they'll read, say, Fridays after hours or just the previous days after hours, and it can be misleading. Hot stocks are up this morning with MJ and MSOS back to back. It still doesn't look very good, other than this is a classic double bottom bear trap setup. We'll know for sure if it actually rallies back up, but that that's like a textbook classic picture for a bear trap. It couldn't get any better if I was trying to draw one. Big move in semiconductors, as I was already mentioning. The concern is that this may be a blow off top. So we had that big gap up last week and we sold back off, and then we were holding within the range. Now we're gapped up again this morning, trying to get outside of that range. I want to measure just that one single candle and look at the 111 because that's our rejection line. If we can get through that, then we've got the 1236, which is sitting at around 272. And then above that, we've got 273.70. My worry is that this is a blow off top. And also you can see this rising wedge. It's not the way I would have drawn it, but yeah. Rising wedges generally break to the downside, but sometimes they'll have this blow off top first to kind of scoop up all the longs and then drop them on their head. For SMH, let's first get back inside of this red bar and then get through the halfback of that red bar. If we can break through the bottom of it, then we've got the halfback of this big green bar. 261.25. Then back down inside of this consolidation here. I'm not necessarily bearish big picture on this. In the broader sense, I don't think, we're going to sell off to 210 or anything, 200. But that was a big move up from this breakout all the way down here at 230, call it 240. We went from 240 to 270. It's probably going to have to sit and chew on that for a little bit. It's a big bite. KWeb through the China internet stocks or the China ADRs. Generally, this would be the Baba, Baidu, JD, PDD, that kind of group. Gap up this morning implies that at least one of those are on the move. Baba, it's just really indecisive, nothing there. Baidu, gap up, and so far it's holding, but it's not even past the midpoint yet. And we would still need to get through the midpoint to the top of yesterday, through the top of yesterday. And you can see this has just been a continuous burn to the downside. So no excitement on that one. PDD looks a little bit better, but still you can see all these wicks showing a lot of defense around that 150. We get up there and it's just getting sold off. This is sell the rip, not buy the dip. Yes, we got a inverse head and shoulders here, but for me, it's in the wrong location. Inverse head and shoulders should be identified along the lows because it is a bullish pattern. And head and shoulders should be across the highs because it's a bearish pattern. And yeah, I know they can be continuations too, but most of the time they're not, right? Any pattern can be the opposite. That's how I have my failed bear flag play. Bear flags are bearish, but when they fail, they make a really beautiful cup, which often forms a cup and handle, which is bullish, and you got your entire reversal there. So this inverse head and shoulders, to me, is something I'm willing to ignore because it's in the middle of this range where it doesn't belong. And whether you call it random walk or just noise from price action, you can look in the clouds and you can see Mickey Mouse, right? You can see Donald Duck and dinosaurs. So you can look at candles and occasionally see a pattern that might not necessarily be a pattern we want to use. JD also gapped up, but again, still within the half back and certainly within Friday's range. Even if we can get back above all that and maybe close the gap at 29.5-ish, then we've still got all of this trash overhead to deal with. For a day trade, sure, if we can continue this drive, but so far the China ADRs through the ones that we just looked at, they're looking pretty poor, not all that exciting. China in general, without focusing on the internet stocks, actually looks a little bit better. It's not up as much, but it doesn't have such a beat down. And to zoom out a little bit, that is a really big daily head and shoulders. Almost too big to have any value, right? But as we would do with any other range, even if it wasn't a head and shoulders, you can just measure the last drive and got your levels lower. If we were going to mark the neckline break, it would be the same point, right? Crude also up, and emerging markets, which we already knew emerging markets should be up because we've got China up, and China's still classified as an emerging market, which I completely disagree with, but they didn't ask for my opinion. Want to see a little bit of a rising tide scenario today. We want to see these others pick up the slack, especially if we're going to see a pause in tech after such a big run, and maybe even with a rebalancing that we got to take a look at. So the 80, the average daily range on well, let's say industrials, building materials, energy, staples, healthcare, utilities. There's a lot of talk about a new nuclear plant in Nevada. Bill Gates should be able to search Bill Gates and nuclear power plant. I don't know how much that's going to change the dynamic, but you know, uranium and nuclear had already been doing really good. And through the last few years, and then we got a bit of a digestion. Could see a resurgence in that area. Not today, at least not yet. All right, Thinkorswim had this as positive with TNX also positive. The assumption was that TNX was wrong and this was right, but on Thinkorswim, that's green, and so that's wrong. It just goes to highlight you can't trust Thinkorswim in the pre-market. That's why I always double check everything on another platform. TrendSpider, TradingView, something. Because Thinkorswim, a little sketchy in the pre-market. Futures aren't sketchy, it's everything else. So we got the gap down in TLT, tight consolidation in the overnight, and then it just completely fell out of bed below 94. It's worth keeping an eye on the levels of yesterday. If we fall outside of yesterday's low, I would be more concerned. So we want to see if this is going to hold the range or not. Let's get there first, 93.5. See if that holds as a support, finds a little stability. It could overshoot, be a really nice double bottom. We would expect it to get tangled up around that 93.40. Worst comes to worst, it gets in the 93.25, but that's the line in the sand. We don't want it going below that level. And as you can see, this will bring us right back to the 200-day. Now, the 200-day is trying to flatten out, but really it's still sloping to the downside. So we can get above it and fight it like we have been. If we're going to see a big change in the bond structure, it's going to take time to turn this 200 around. We've got to get completely above it and hold above it, get that 200 turned in the other direction, pointed to the upside. And even then, we're still going to come back down and test against it. So if you're a longer term bond bull, got a lot of work ahead. On the day, just need some structure. Need this to quit falling, find some stability. I mentioned that Thinkorswim and TNX isn't working. This is what I get when I try looking at TNX. So I use the 10-year futures. We're still inside day here too, which makes sense. So we want to see that change, get our inside day breakout. If we get a rejection here and it holds the line and starts to fade back, should be helpful for equities out there. Dollar's not helping on it and anything. It's just tight sideways. I'd watch this for a change. That white line is a 3-period moving average. As long as we're holding above it, we're still in surge mode. There's the cross up. So a little bit lag from the expansive move on Friday. All we got to do is tag that for a reset and continue the move to the upside. And crude's still holding the range. Get above 79 and we can measure this entire zone, plot it to the upside. It should give us like 83, 84. Oh, I was way off. 79.65. It's a good start. And then 80, call it 80.50. a little discrepancy with US dollar Japan versus the dollar. Could be seeing a little move in their 10-year. I mean, not much yet. They are back under the 1.0 line in the sand. We'll see if it continues to drop or not. It's worth keeping your eye on. If this starts to give another run to the upside, we don't expect the markets to fall in a straight line, right? So we've already got our lower high and our lower lows. It would make sense to come up and set another lower high. That would be a full set, 2 lower highs and 2 lower lows. That put us on a confirmed trend to the downside. So watch the clock, keep your eye on the advancing versus the declining issues. Look for money flow divergence and a rising tide scenario, so that if we're not going to get help out of the Mag 7 and the tech, say they kind of dry up a little bit around that semiconductor volume this morning, then maybe we can get a little bit of help on everything else. See y'all tomorrow.